Hello everyone and welcome to this month's Ask the CFP segment brought to you by Executive Compensation Group. This month's question is, what taxes apply with an inheritance? This is a solid question because I find many people are confused by the topic. First, let's assume we're talking about an inheritance that's less than $11 million. This means the estate is under the estate tax exemption of $11.18 million for 2018. If that's the case, federal estate taxes generally don't apply. However, some states levy their own inheritance tax or estate tax. Aside from the estate tax, what other taxes may apply with an inheritance? The most common tax I see when someone receives an inheritance is income tax from retirement accounts or tax-deferred annuities. Let's assume you inherit someone's pre-tax IRA or pre-tax 401k and it's worth $1 million. Technically, this account is worth $1 million, but since Uncle Sam hasn't been paid on these assets yet, it's not really worth that much in my eyes. If you decide to cash out the entire account in 1 year, it will be treated as a taxable distribution and be added to your earned income. If you make $100,000 per year at work, you may be taxed on $1.1 million that year. You can imagine that a fair amount will be lost to federal and possibly state income taxes if you do this. However, if you've used what's called an inherited IRA, you may be able to transfer these assets into an IRA in your name and defer most of the taxes into the future. If you do this correctly, you only need to take out what's called an annual required minimum distribution, which is a percentage of the account's value. I don't know about you, but I'd rather pay tax on a small amount of income rather than a large amount of income. If you inherit a tax-deferred annuity, it's similar to the pre-tax retirement example I mentioned. However, you may have something called cost basis to deal with in an annuity. If the annuity is worth $1 million and the cost basis is $500,000, then only half of the annuity is taxable. The cost basis portion is typically tax-free. Again, you can take out all the funds in 1 year, but then you have $500,000 that would become taxable. Instead, you may be able to transfer it to your own annuity and defer the taxes if it makes sense. If you inherit other kinds of property, such as real estate or stocks that aren't held in a retirement account, you may not owe tax on any of it thanks to a special tax rule called step-up in basis. For example, if your grandfather had stock he paid $500,000 for and it grew to $1 million, he has a taxable gain of $500,000. However, if you inherit this stock, you may be able to enjoy a step-up in basis based on the stock's value on the date your grandfather passed away. The basis may then go from $500,000 to $1 million, and if you sell it while it's worth $1 million, you may not owe any capital gains tax at all. This is a unique part of the tax code, and you should know about it in case someone is thinking about selling highly appreciated assets at their old age. Overall, inheritance planning may be less complicated than you think. If you're about to receive an inheritance, contact a CPA and a CFP right away to create a plan for minimizing taxes where possible. If your CFP isn't bringing this information to you via wonderful videos like this, then it's time to give us a call instead. If you have a question you'd like to submit for next month's video, send it to tfreeman@rfgadvisory.com. Thanks for watching, and we'll see you next month.